The question on every investor's mind right now is, where is the recession? The stock market is booming, the real estate market is growing, and companies still can't find enough workers. And naturally, this boom that we've been seeing has caused people to start partying and celebrating the end of a potential recession. We've been seeing consumer sentiment rally and everyone's saying that the chances of a recession are gone. And all of this sentiment put together is part of the reason why Wells Fargo recently put out an economic report where they said essentially, whoa, hold on there, cowboy. We at Wells Fargo still believe that there's a recession coming ahead. And interestingly, this economic report was published right around the time that they released their earnings, where they said that their profits are booming. And Wells Fargo didn't hold back in their economic report. Let me actually read you their first line from this report. It said, better than expected, talking about the recent boom in asset prices and the economy does not mean all is well. To get right to the point, what Wells Fargo says is that, in our view, the best news for 2023 global growth is likely in the past. Now, I've already spent the time going through and analyzing the report, and I'm going to break it down for you here. But if you want to read the report for yourself, I will link it down for you in the description. And while you're in the description, on August 15th of this year, it is going to be the 52nd anniversary of the United States dollar being taken off of the gold standard. And because of that, I'm going to be hosting my first ever investor summit. In this live call, I'm going to be going over how the dollar and our economy has changed over the last 52 years. But even more important than that, I'm going to be talking about the new investment opportunities that we're seeing and how you can capitalize on this changing economy. There's going to be so much value on this call. It's completely free. So if you want to join, it's live. I have the link for you down in the description. And I also need to let you know that there is a limit to the amount of people that we can have on this call. This is my first time doing this, but there is a limit because the software has a limit to the amount of people that can actually attend live. So if you want to join, there's going to be a ton of value. Make sure you register using the link down in the description below. And also, make sure you join on time, because if you get in and it's full, then unfortunately, you're not going to be able to join. There are 5 main points that Wells Fargo talked about in their economic report. Number 1 is that the economy is still chugging along, but it's losing steam. Number 2 is that the labor market is still too tight. Number 3 is that inflation is still too high. Number 4 is that fiscal policy or government spending is going to be a concern. And number 5 is the international developments and the United States dollar. So let me start by talking about number 1, which is the economy is still chugging along, but it's losing steam. Essentially, what Wells Fargo is saying about the economy is that, well, it's been resilient. In fact, it's been more resilient than really anybody, including them, thought. But this does not mean that we're not going to see any sort of economic slowdown. And in fact, we're starting to see the impacts of an economic slowdown now. What they said is that the economy has continued to weather the headwinds stemming from the tighter monetary policy and the fading of fiscal support better than generally expected. That means although we've been seeing the higher interest rates, that means although we've been seeing the government cut back on stimulus, that means although the Federal Reserve Bank has been doing quantitative tightening, we haven't seen a drastic slowdown at all in the economy, which was unexpected. However, what they're saying is that the excess money from the pandemic and all the stimulus is starting to fade away. And when that happens, plus when student loans restart, which is really the last kind of incentive program from the pandemic, that's when they expect to see more changes in the economy later on in 2023. Here's what they said. Only about 1/4 of excess savings remain, and it's being tapped at an even slower rate, while the availability of and demand for consumer credit is declining amid the higher interest rate environment. Later this year, student loan payments are going to restart, which is going to be a headwind for households with student debt. Remember, our economy runs on spending. The more money you spend, the richer somebody else gets. And what Wells Fargo is saying is that the spending ability is going down. Why? Because this excess cash is going down, and people's ability to spend on debt, because we live in a credit-based economy where people can spend not just based off of how much cash they have, but based off of how much debt they can qualify for, credit is tightening up. Why is it tightening up? Number 1, banks are being more strict, but number 2, interest rates are also higher. So people are less willing to go into debt to spend, and people have less spending ability because they have less cash left over to spend. Then to top it all off, We have the student loan payments that are restarting towards the end of 2023. And this is where Wells Fargo is saying once all these things really start to play out in the coming 6 months, that's when we'll start to see more headwinds in the economy. They said we expect the ongoing squeeze on credit and profits to lead to a contraction in business fixed investment as the year progresses. In other words, if people start spending less money, that means businesses are going to make less money, and if they start making less money, they're going to stop investing money back into their businesses, which would lead to that economic slowdown that they're talking about. This brings us to the second point that Wells Fargo talked about, which is that the labor market is still too tight. At some point over the last 24 months, you've probably heard the Federal Reserve Bank or the government or some economist saying that the labor market is too tight. What that means is that employers are still having a tough time finding employees. This chart from the Bureau of Labor Statistics helps to explain that. And what you see is that right now in 2023, we're still seeing this economy where there are more job openings available than people that want a job. This is unlike anything we've seen in recent history. This is creating that tight job market, which is also contributing to inflation, but this is creating that tight job market, which the Federal Reserve Bank is working to change. They want to raise interest rates to loosen and soften the job market, which means essentially they want to get rid of some of the jobs out there, aka increase unemployment. That's the unpolitically correct way to say it. But when you hear somebody say loosen the job market, that means higher unemployment. Wells Fargo says that we expect job growth to turn negative in the spring of 2024 and for the unemployment rate to peak around 4.6% in the second half of next year. Now, for full transparency, currently we're at about 3.5% unemployment, which is some of the lowest unemployment we have seen in decades. 4.6% unemployment, which is what Wells Fargo is predicting for the second half of 2024, is still historically pretty low, but that would require that a couple million Americans would have to lose their jobs between now and next year in order for us to hit that unemployment number. But the reason why they're expecting unemployment levels to go up goes to inflation and the fight on inflation. The weight of this evidence still suggests that the labor market remains too tight to be consistent with 2% inflation, and we expect more softening in the labor market in the months ahead. There you go. What Wells Fargo is saying is that the job market is too tight to have this 2% inflation. The Federal Reserve Bank wants to bring inflation down to 2%. But in order to bring inflation down to 2%, what Wells Fargo is saying, you can't have a labor market with such low unemployment. The reason why is because now when you have such a tight labor market, companies have to compete against each other to get an employee. Now, for a company to compete against one another to get an employee, what do? They're going to offer you more benefits and a higher salary. Now, that might sound like a good thing, which it is if you're an employee, but that can also contribute to higher inflation because if you make more money, what do? You spend more money. If you spend more money, that's higher demand. Higher demand means, well, more people buying things, which can push the prices of products up. This is where now Wells Fargo is looking at what the Federal Reserve Bank is saying, which is the Fed wants to soften the labor market, right? That's the politically correct way to say they want to increase unemployment. The Federal Reserve Bank wants to soften the labor market, which means more unemployment ahead. This brings me to the third point that Wells Fargo made, which is regarding the inflation numbers that we're still seeing. As expected, recent data shows a downward trend in inflation, which is clearly underway, but a sustained return to 2% inflation seems a ways off. Now, I think one of the most misunderstood parts of the inflation numbers is what is the actual inflation that we're seeing, and that actual inflation really just depends on your lifestyle and how much the expenses of things that you're buying has risen. But when you see reported inflation numbers, they're not all the same because what the Federal Reserve Bank is looking at isn't always what you're looking at. For example, you might have heard the CPI has fallen to 3% and everyone's celebrating because now inflation is almost at 2%. But that's not what the Federal Reserve Bank is looking at. The Federal Reserve Bank looks at something called PCE, also known as core inflation. And core inflation hasn't fallen down to 3%. Core inflation has fallen to 4.8%. The next thing that you want to understand is why inflation might be falling. The gradual weakening in demand and improvement on the supply side of the economy is beginning to more clearly translate to lower inflation. So they say that inflation is falling because we're seeing weakening demand and improving supply. So when the Federal Reserve Bank is working to raise interest rates to cool down inflation, what they're working on is decreasing demand. What does that mean? It means less people wanting to buy things. How? Because when you raise interest rates, it's more expensive. right? When you have higher interest rates, it's more expensive to go out and buy a car. It's more expensive to shop on your credit card. So when the Federal Reserve Bank is raising interest rates, they're trying to reduce demand. And this is where Wells Fargo is saying that demand is falling. Why is demand falling? Well, partially because of the higher interest rates, partially because of the high inflation, partially because of people running out of their savings, and partially because people are racking up their debts. So we're seeing demand beginning to fall, and the supply is starting to increase. Why is the supply starting to increase? Well, we all remember all the supply shortages that we had during the pandemic. And over the last number of years, companies have been working to produce more products, which has been working to increase that supply. So we're starting to see the increase in the supply side of things, which is starting to see more of the equilibrium. Demand is starting to fall, supply is starting to rise, which is causing an easing in inflation. This is where Wells Fargo predicts that by the fourth quarter of 2023, they expect both headline and core PCE inflation to be running closer to the 3% than the 2% numbers when measured on an annualized basis. So the Federal Reserve Bank is trying to bring inflation down to 2%. And Wells Fargo is saying that they're predicting that by the end of 2023, inflation will not be at 2%, but probably closer to the 3% number, which means more work ahead to really bring inflation down. And remember, when inflation falls, that doesn't mean that the prices of things are falling. That means that the prices of things are rising, just not as fast. The fourth point that Wells Fargo talks about kind of briefly is fiscal policy. What is the government doing with their money? Because a big reason of why we are here today, economically, financially, is because of, the government spending that we saw in 2020 and 2021 into 2022. Even today, we still have some of that COVID precautions and programs out there with the student loans programs being paused. But what is the government going to do? And the main factor that Wells Fargo really talked about here was the debt ceiling. Now, you might remember a little bit earlier in 2023, all the drama that was being created over the debt ceiling almost being reached. Well, that might be happening again. Congress still needs to pass the 12 annual appropriation bills or a continuing resolution by September 30th to avoid a government shutdown. The real reason why this matters is because the government is one of the biggest spenders in the economy because there's really no limit to how much the government can spend. Sure, they have this debt ceiling, but the debt ceiling always has been getting extended. So if the government spends money, maybe they hire police officers, maybe they build a bridge, maybe they hire teachers, money is going into the economy, right? When they create jobs, whether they're paying a police officer, a teacher, or anybody in between, a construction worker, somebody's getting paid. And when somebody gets paid, they have the ability to go out and spend, which helps stimulate the economy. And when the government wants to build new bridges, they're paying contractors, they're paying engineers. That's people getting paid, which helps stimulate the economy. So when the government spends money, people get paid, which stimulates the economy. But there's a cost to the government spending money that they don't have. That's inflation. See, the government is running this large national deficit, meaning they're spending more money than they bring in. And that accumulates into the national debt. We now have about $32 trillion worth of national debt. So when the government keeps spending money that they don't have, there is a consequence to that. I mean, if there wasn't consequences, why do we even have to pay taxes in the first place if the government can just print all their money? The consequence is inflation. So the main topic that Wells Fargo is really talking about is, what's going to happen with the debt ceiling? But they also kind of say optimistically that the government can hire some more people if they wanted to keep stimulating the economy. We, Wells Fargo, believe that there's still room to hire more state and local people. And this brings me to the fifth and potentially most interesting part of Wells Fargo's economic report, which is international developments and the United States dollar. Here's what Wells Fargo has to say about our economy. We forecast global growth of 2.7% this year, with risks tilted towards slower growth as China's economy struggles to recapture momentum. Now, most of everything that I cover and talk about has to do with the United States economy because my company, Briefs Media, is in the United States. We cover what's happening in the United States economy. So we don't always cover that much of what's happening in the broader economy. What Wells Fargo is saying is that we're seeing slowdowns in many different parts of the economy and major countries around the world, which could trickle down to the United States because these countries are buying things from the United States. They say that China's economic recovery from COVID is over, The Eurozone slipped into a recession early this year and is likely to experience subdued growth going forward. And in Europe, the UK also continues to be disrupted by higher inflation. Now, while you might be thinking, but these countries are not the United States, why does that impact anything that happens here? They're all the way across the sea. Well, these countries are also major economic players in the global economy. Plus, they're major trading partners with the United States. So if their economies are slowing, that could mean that they're buying less things from the United States, which could hurt the economies here in the United States. But what's interesting also, beyond just the global economies, is what's going on with the United States dollar. Because number one, there's worries about the valuation of the dollar, especially when you have high inflation. Now, I should also say that people have been worried about the health of the dollar ever since the dollar was taken off of the gold standard back in 1971. But especially after the spending that we saw during the 2020 pandemic, people had naturally been worried about the health and the security of the United States dollar. Well, at the same time, we've been seeing a lot of different changes happen with countries and currencies overseas. Like we've been seeing the BRICS nations, Brazil, Russia, India, China, and South Africa come together, working to create their own currency, working to potentially create a currency backed by physical gold. That way they can divest away from the dollar. Now, our dollar here in the United States isn't backed by any precious metals. It's backed by the health of the United States government. It's backed by the promise of the United States military, and it's backed by the strength of the United States economy. But it's really just faith in the dollar that keeps the dollar running. And so if countries overseas start to lose faith in the dollar and they start to divest from the dollar, what does that do? That could hurt confidence in the dollar. And if confidence in the dollar gets hurt, that could hurt the valuation of the dollar. If the valuation of the dollar gets hurt, well, that could really cause more inflation. Now, fortunately, the dollar is the world's reserve currency. That is the best thing that the United States has going for it. But if it were to ever lose its reserve status, that could devastate the valuation of the dollar. And what could cause the United States to lose its reserve status? Well, things to hurt the value of the dollar. And this is where understanding that that is a pretty big thing to happen. It doesn't just happen willy-nilly. But if that were to happen, that wouldn't be good. And so this is where now Wells Fargo is saying, well, number one, we have all these different things happening in the world right now. Right now, there isn't really a replacement for the dollar, but there's a lot of economies that are slowing around the world. These major economies slowing in the Eurozone, in Europe, in China, well, these economies could hurt the United States economy because that's less money coming into the United States if they don't have money to spend. In addition to that, we also have the risks with the dollar. And especially when you have high inflationary problems, that poses more risks to the dollar, which is something that you want to be aware of. This is where Wells Fargo says that the majority of downside risks in the global economy come from China. So now when you piece all of these things together, we have an economy that is still strong. It's strong because consumers are spending and people have the ability to spend. But this is where Wells Fargo is saying, well, that might not keep staying like this once the excess savings get dried up, once student loans restart, and once people start tapping out on their debts. Once that happens, people might start spending a little bit less. If they start spending less, businesses are going to make less money. If businesses start making less money, well, they might start investing less into the businesses, which could cause a softening in the labor market. Softening in the labor market means higher potential unemployment. Higher unemployment means less people with jobs. And that could also contribute to lower inflation because that's less demand. If people don't have an income, they don't have the ability to spend. If you don't have the ability to spend, well, that's going to be less demand for products at a time where supplies of products are also increasing because companies have been working to increase the supply of their products. And in addition to that, the tighter monetary policy, the higher interest rates, that's going to take some time to really feel the effects of that, while we're also seeing slowdowns in the global economy in China and Europe. So culminating all these things together, this is why Wells Fargo is saying, yeah, in the short term, things are looking great. But that doesn't mean that everything is going to stay great. And the interesting thing about a recession is that recessions don't happen when people expect them to happen. They happen when people don't expect them to happen, when people don't have the money to capitalize on recessions, because if people have a ton of money sitting on the sideline, you don't have a recession because anytime you see a little drop, people come in and buy. So, what does this mean for you? It does not mean you should blindly trust Wells Fargo. It does not mean you should blindly trust a random guy on YouTube. This means get educated. Be aware, understand the different points of view. Right? We cover what's going on in Market Briefs, my free financial newsletter. I'm going to be covering what's going on in my Investor Summit for free. But this is where it is, number one, important for you to stay up to date on what's happening, because we're seeing a lot of changes happen. There's a lot of different opinions about what's going on, but you want to understand what's happening. That way, number two, you can also be prepared. Being prepared means getting financially educated. I cannot say this enough, but 2023 is not the year to go out and finance a new truck. 2023 is the year for you to get financially educated. That way, you can be smart with your money. 2023 is the year for you to get financially smart. Put money aside. Get smart with your money. Build a savings cushion to protect you in case of an emergency. Build a savings cushion to be able to capitalize on asset opportunities in case you see asset prices drop. Then the third thing that you need to do is really work on that financial education. Learn about investing. Watch YouTube videos. Listen to podcasts. Read books. You don't have to go out and start spending a ton of money until you're ready to. Start actually just watching free content. When you figure out something that you want to learn more about, maybe you want to learn more about investing in real estate, then go out and read a book on real estate investing. I don't have any books to sell you. I haven't written a book. I don't have time to write a book, but maybe I will in the future. But right now I don't. But there's a ton of amazing books out there on how you can start investing in real estate, how you can start investing in stocks, how you can build your own company, how you can invest in startups. Figure out what it is that you want to do and then start reading books. And then you can start doing it. And then as you start doing it, if you want more help, you want more education, start taking classes, invest in your own education, invest in learning from people who have already done it, because you can shorten the time span that it takes to learn by paying somebody else to show you what took them years to learn. It's kind of funny. Recently in Briefs Media, we hired a consultant to advise us on how we can improve the efficiency in our newsletter. And some of the things that he proposed to us on our sales side, because we have sponsors in our newsletter, was how we can improve the sales of our newsletter. And there were some little tweaks that really weren't that big of how we can package our ad products, how we can package our sponsorships, which we think can improve our revenues by around 80% by just doing a few tweaks. Now, they're not groundbreaking things, but it probably would have taken us 2 or 3 years to figure out how to do this. But because we just paid somebody, it was kind of expensive, but because we paid somebody, we were able to save ourselves 2 or 3 years. So yeah, paying that money was definitely worth it, because now we were able to save years worth of time trying to figure it out ourselves. So once you start doing it, keep investing in your own education, because that's how you learn. As soon as you think you know everything, well, you really don't know anything. It's kind of funny. The first time you go out and start reading a book, if you read a book on real estate, you might think you know everything about real estate investing. But once you go out and you read 20 books on it, you realize, oh my God, I really don't know anything. The more you learn, the more you realize you don't know. And that's when you're going to really build that quest and that journey to keep learning. So build that financial education, get financially prepared, and stay up to date on what's happening, because there's a lot of opinions out there. There's a lot of emotions out there. The markets are all emotional. That's how they work. But now, because of social media, the internet, and all these online communities, well, people can perpetuate their emotions about what's going on, and it can really entice people to sell or buy based off of what the emotions are at the moment. But your job is not to be an emotional investor. It is to be a financially educated and calm investor, because no good investment decision happens out of panic, no good investment decision happens out of fear, and no good investment decision happens out of greed. They happen out of financials and a calm mind. And if you can master that, you're going to have the ability to capitalize on opportunities that will come your way. It looks like home prices are finally dropping. Let me read you the title of this article from Reuters. U.S. existing home sales edge up, but prices drop by the most since 2011. The article goes on to say that the median sales price was $396,100, which is a 3.1%